Hello, everyone, and welcome to this Flashcast edition of our weekly market in thematic research themes and thoughts commentary. Today, I want to discuss a piece of research published this morning called Cost of Equity, the Pivot, Why Structure Now Matters More Than Rates. My name is Shawn Severson, CEO and founding partner of Water Tower Research and head of market commentary and thematic research. I think there are a couple important things that we all get trapped and maybe not look close enough at when we talk about small cap investing. Obviously, it's a very exciting area. Thousands of companies, great opportunities, emerging technologies, but investors really have to understand a couple things. The playbook has always been interest rates go down. It's usually very good for small cap stocks, domestic economy. We'll all see those things taking place, and it's showing up this year so far. Russell 2000 up 7% year to date, beating the S&Ps, roughly 2%. So showing that the outperformance. Now keep in mind this is coming after a very long dry spell for small caps. So the playbook is working. The traditional playbook is there. So again, it's been a great trade so far. But what do we need to look for in 2026? I think there are a couple things that are critical for investors to understand. And again, it's very exciting because you got 2,000, 3,000 different companies to look at, great options, but you got to get into them. You got to dig through and understand using good research and particularly pay attention to the balance sheet and things that are happening in the company's cap table. Because I believe the true innovation economy in 2026 is not really the cost of debt when we look at interest rates, but it's going to be the cost of equity. And this translates into the ability without punitive dilution for companies to raise capital and grow. And there's an important delineation that investors should look for. And we're witnessing a structural shift from survival financing. And that's been, what so many small cap companies and micro cap companies have been stuck in for several years at this point. That I'm talking about toxic warrants, made big discounts to the market, very high cost or complicated debt structures and converts, and really focusing on the ability to get to growth financing, clean equity. And by this, I mean it'll allow high quality small caps to play offense again. So when you're looking at the companies and you're looking at this, a company you've been following for a while or came across a new one, make sure you're digging in this to understand, have they raised capital? Can they raise capital? Are they in survival mode, or are they are ready to kick into the growth mode? And a lot of these companies don't make money. I mean, depending on the quarter and who you talk to, up to 40%, 45% of the Russell 2000 doesn't make money. And I don't know the exact number, but I bet if you look into those that, quote, do make money, many are just getting by. So again, having capital to invest in growth really is the story for these emerging growth companies in small cap and micro cap land. We all know the Russell trades at a discount to the S&P, obviously more risk, more financing risk, smaller companies, all the things that create that discount. But the point is there's a huge opportunity to get some margin expansion in the Russell 2000, companies to grow, and for this gap to lessen. So the cost of equity flywheel is emerging, and I want people to understand that investors look at the cost of equity flywheel is emerging. By that, rising stock prices lower the cost of capital. This enables management to raise lower cost equity and accelerate investment. This is a big reversal from what we've seen in 24 and 25, but it requires diligence, digging into the company, understanding the balance sheet. Pay attention to this because you can have a great company, and if they're not able to raise capital at a reasonable rate, we've all seen this as small cap investors and analysts. Good company, stock goes up, stock gets hit with a highly dilutive deal. It really stunts the growth, takes the winds out of the sail, and you're back where you started or even worse. So understand the capital structure and the cap table and what's going on. It's important, though, to note recently, and we've seen this a lot throughout our coverage and in other companies, markets are rewarding solvency over punishing dilution. By that, I mean capital raises on good terms often cause stocks to rise in an extended runway where the value exceeds the dilution costs. This means a good company is getting funded. They got a good deal put together. The equity is there, and not just survival capital to get through the next quarters, but to really execute on their business model. This is a critical thing to understand and an important part of small cap and micro cap investing. Our approach is looking at a barbell strategy. If you look at the S&P 500 small cap, you'll see that most of those companies, they're industrials, energy services, they make money And they did really well out of the beginning because investors knew they weren't going to need to raise capital. They had cash flow and they were profitable. So you start with that, but then you want to add to the funded innovators, we call it, and look at biotech, applied AI, energy technology that have raised clean equity, or importantly, have the opportunity to raise clean equity, because you're going to see, I think the market has opened up. I think the numbers show that. We're seeing it across the companies we work with in small cap land. And the access to capital is getting easier and better, and there's some good deals getting done, and the stocks are going up. So, in conclusion, today for the WTR Investor Network, just wanted to say the 2026 playbook: clean cap tables, toxic cap tables out. The maturity wall will filter out companies that cannot access new equity windows and supercharge those that can't. So look at your favorite ideas, understand what's out there, take a look at that cap table and figure it out. And as a reminder, you can read this researcher piece on our website at www.watertowerresearch.com, where all of our research events, podcasts, fireside chats are accessible to all investors. So again, thank you everyone in the WTR Investor Network for taking the time today. Again, Shawn Severson, CEO and founding partner of Water Tower Research. Have a great day and thank you.